There's a really big policy idea making waves in India's banking world right now. It's something that could totally change the game for the country's state-run banks. The plan? Well, it's pretty simple. Open up the floodgates to foreign money. And when I say floodgates, I am not kidding. We're talking about a move that could, by some estimates, unleash up to $4 billion in foreign investment. That is a massive number, and you can bet it's got the markets buzzing. But this really gets us to the heart of the matter, doesn't it? Is just throwing billions of dollars at these banks the fix they actually need? Is this the silver bullet everyone's been hoping for? Okay, so what's the actual proposal on the table? It's a big one. The government is thinking about more than doubling the cap for foreign institutional investment in public sector banks, or PSBs as they're known, from the current 20% all the way up to 49%. Now, to put that into perspective for you, private banks in India can already have up to 74% foreign direct investment, which is usually the long-term, sticky money. So on the surface, raising the cap for public banks seems like a pretty logical step to level the playing field. But, and this is a big but, there's a multi-billion-dollar catch. And this is exactly where that simple, catchy headline starts to get a whole lot more complicated. It's all about this fundamental disconnect between owning a piece of the bank and actually having any real say in how it's run. And here is the paradox at the heart of it all. A foreign investor could, in theory, own almost half of a state-run bank, a huge 49% stake. But their voting power, their actual ability to influence anything, it would be capped at just 10%. So why the massive disconnect? To get that, we actually have to rewind the clock way back to the 1970s. When India nationalized its big banks, lawmakers slipped in a pretty clever rule. To make sure the government always had the final say, they capped any single private shareholder's voting rights at 10%, no matter how much of the bank they owned. And believe it or not, that rule is still on the books today. And that really gets to the core of this strategy here. As one analysis put it so well, this isn't about handing over control, it's about handing over risk. See, these state-run banks have to do things like lend to farmers and open branches in remote villages. The government wants foreign capital to help pay for all that, without ever giving up the driver's seat. But this whole situation forces us to ask an even bigger question. Is a lack of money even the main problem these banks are facing anymore? I mean, think about it for a second. Thanks to a strong economy, these state-run banks have actually cleaned up their books and have been posting record profits lately. So, if that's the case, is more cash really the medicine they need, or have we just got the diagnosis all wrong? Just look at this. In less than a decade, the share of household deposits held by public sector banks has dropped from 70% down to about 60%. That's a huge drop. This isn't a capital problem, it's a customer problem. Plain and simple, people are taking their money somewhere else. So where are they going? Well, to a whole new world of competitors. We're talking about private banks with way better apps, super nimble fintech companies, and all kinds of specialized finance corporations. The whole battleground for banking has shifted. It's not just about lending money anymore. It's about who gives you the best experience. And that's exactly where the state-run banks are losing. So, if the problem isn't just a lack of money, what happens when you go and inject billions of foreign dollars into the system anyway? Well, you get some pretty serious unintended consequences. Let's dig into the real risk of what some are calling easy money. So here's how it works. It's like a chain reaction. When the investment cap goes up, those big global stock indices, they have to increase the weight of these banks. That then forces these huge passive funds, the ones that just automatically track the index, to buy up the shares, which pumps up the price. But it's a double-edged sword. When those same funds decide to sell, it can cause a stampede for the exit, making any crash on the way down way, way worse. And this creates a really dangerous side effect: complacency. I mean, think about it. If your bank's stock price is going up automatically because of these index rules, what's the real incentive to do the hard, messy work of actual reform? You could just ride the wave of easy capital instead of getting truly competitive. Okay, so if this proposal isn't the whole answer, then what would real, meaningful reform actually look like? How do you build a state-run bank that can actually compete and win in the future? Well, a blueprint for real change would probably focus on three key things. First, using any new money for a deep-down tech transformation, not just for padding the balance sheet. Second, shifting the entire focus to winning back customers and stopping that deposit bleed. And maybe most important of all, fixing the massive gaps in how these banks are run. And look, this isn't just some theory. Major banks like Bank of Baroda and Indian Bank are supposed to have 16 directors on their boards. Right now, they're running with just 10. That's a huge leadership vacuum, and it creates a major roadblock for things like accountability and, planning for the future.
So, at the end of the day, what do we really have here? Raising the foreign investment cap is a fantastic headline. It signals change, it looks bold, but for now, it's a policy that kind of hints at reform, without any of the fine print that would actually guarantee it. It feels more like the promise of a solution, without a real plan.
And that leaves all of us with one final, really provocative question. If these deeper, fundamental issues aren't fixed first, are we going to be right back here in a few years, after billions have flowed into the system, asking ourselves a very simple question? So, where did all the money go?